Hi, it's Sylvia from IFRSbox.com. Today I want to give you the overview of the standard IAS 39 Financial Instruments Recognition and Measurement. Standard IAS 39 in its more or less current form came into effect in 2005, and it should have ensured higher degree of transparency and consistency of financial instruments reporting. However, as it is a very complex area, also IAS 39 ended up being too complicated with too many exceptions, derogations and inconsistencies, and left many users confused. Therefore, in 2008, IASB decided to rewrite IAS 39 and launched the project of IAS 39 replacement. The result of this project should be a completely new standard on financial instruments. Now we know it's IFRS 9. The replacement process should have had three phases. Phase 1, classification and measurement. Phase 2, impairment methodology. And Phase 3, hedge accounting. So where are we now? Phase 1 has already been completed, and currently we have IFRS 9 that deals with classification and measurement of financial assets and financial liabilities. Phases 2 and 3 are still in progress, but not very far from full completion. So, in fact, as I make this video in February 2012, there are currently two standards dealing with financial instruments: IFRS 9, the new standard, and IAS 39, the old standard. IFRS 9 currently contains new rules for classification, measurement, recognition, and derecognition of financial assets and financial liabilities. The old standard IAS 39, which is still in place, contains these old rules for the same items as IFRS 9, plus rules for impairment of financial assets and hedge accounting, just mentioning the biggest things. So, which standard should you apply, IFRS 9 or IAS 39? Well, in 2015, application of IFRS 9 will be mandatory, and standard IAS 39 will be superseded. You will be no longer able to utilize it. But until 2015, you have a choice. You can decide on early application of IFRS 9. In this case, you would apply IFRS 9 for classification, measurement, recognition and derecognition of financial assets and liabilities. For impairment and hedge accounting, you would apply old IAS 39 because IFRS 9 does not contain the new rules for those areas yet. You can also decide to apply IAS 39 in full. In this case, you can completely forget about IFRS 9 until 2015. Therefore, this video is about old IAS 39 in its entirety, but we will touch only the major points due to its complexity. So let's talk about the financial assets first. IAS 39 classifies financial assets into four main categories. Financial assets at fair value through profit or loss. These are financial assets that are either classified as held for trading, or upon initial recognition they are designated by the entity as at fair value through profit or loss. All derivatives fall into this category. The second category is held to maturity financial investments. These are non-derivative financial assets with fixed or determinable payments and fixed maturity that an entity has the positive intention to hold to maturity, but other than those designated at fair value through profit or loss upon initial recognition, or other than those designated as available for sale and those that meet the definition of loans and receivables. The third category is loans and receivables. Those are non-derivative financial assets with fixed or determinable payments that are not quoted in an active market, other than those that entity intends to sell immediately or in the near term. These would be held for trading. Other than those designated at fair value through profit or loss upon initial recognition. Other than those designated as available for sale, and other than those for which the holder may not recover substantially all of its investment other than because of credit deterioration. The last or fourth category is available for sale financial assets. These are non-derivative financial assets designated as available for sale, or financial assets that are not classified in either of the three previous categories. Initial classification of financial assets is very important for their initial and subsequent measurement, as well as for recognition of gains or losses. Initial measurement means simply the amount in what the financial asset is recognized in the financial statements at its acquisition. Standard IAS 39 requires to measure financial assets at fair value through profit or loss at fair value, and for other assets at fair value including transaction costs. Subsequent measurement means, simply speaking, the amount in what the financial asset is carried in the financial statements after its recognition, for example in the second, third year, and so on. Financial assets at fair value through profit or loss shall be remeasured to their fair value. Held to maturity financial investments and loans and receivables shall be carried at amortized cost using the effective interest method. And available for sale financial assets shall be remeasured to their fair value too. The exception here are investments to equity instruments like shares that have no reliable fair value measurement. In this case, they shall be carried at cost. IAS 39 also prescribes how to account for gains or losses from subsequent measurement of financial assets. For the first three categories, you shall put gains or losses from remeasurement of financial assets to profit or loss. For available for sale financial assets, gains or losses shall be recognized to other comprehensive income. Then at derecognition, for gain or loss from other comprehensive income shall be taken to profit or loss. This is known as recycling. Of course, impairment of these assets shall be put straight to profit or loss. Referring to financial liabilities, things are a bit less complicated here. IAS 39 basically classifies financial liabilities into two categories. Financial liabilities at fair value through profit or loss. These are financial liabilities either classified as held for trading or upon initial recognition designated by the entity as at fair value through profit or loss. The second category are other financial liabilities measured at amortized cost using the effective interest method. Initial measurement of financial liabilities at fair value through profit or loss shall be at fair value, and other financial liabilities shall be measured initially at fair value including transaction costs. With regard to subsequent measurement, financial liabilities at fair value through profit or loss shall be measured at fair value, and other liabilities at amortized cost using the effective interest method. Gains or losses from remeasurement of financial liabilities shall be recognized to profit or loss. The recognition of financial assets is discussed very extensively in IAS 39. Application guidance contains decision tree related to the recognition. So instead of listing the rules for the recognition, let's go through the decision tree. Before deciding on the recognition, you shall determine whether the recognition relates to the whole asset or only to its part. Then apply the decision tree to what you determined. The first question is easy. Have the rights to the cash flows from the asset expired? If yes, then derecognize the asset or its part. If no, then we are going to determine whether the asset was transferred or not. IAS 39 provides extensive guidance on transfers of financial assets. So the next question is, has the entity transferred to somebody else its rights to receive the cash flows from the asset? If not, that means that entity still receives cash flows from the asset, and thus the next question is whether the entity leaves these cash flows for itself or has the obligation to pay them. If there is no such obligation, then the entity continues to recognize the asset. But if there is such obligation, then the next question is whether the entity has transferred substantially all risks and rewards from the asset. If the company transferred its rights to receive the cash flows, then we come to the same question. So if the entity transferred substantially all risks and rewards from the asset, then the asset is derecognized. If not, then there is another question. Has the entity retained substantially all risks and rewards from the financial asset? If yes, then an entity shall not derecognize the asset and continue to keep it in its financial statements. If not, we come to the last question. If an entity has not retained the control of the asset, then it can be derecognized. But if some control is retained, then an entity continues to recognize the assets to the extent of entity's continuing involvement. Derecognition of financial liabilities is a bit more simple. Financial liability shall be derecognized when it is extinguished, and it is when the liability is discharged, cancelled, or expires. Let's briefly touch the issue of embedded derivatives as arranged by IAS 39. Embedded derivative is simply a component of a hybrid instrument that also includes a non-derivative host contract. For example, rental contract concluded for several years in advance with rental price adjustments according to inflation measured as Consumer Price Index in European Union. Non-derivative part in this case is a rent of some property or facility. An embedded derivative part is then forward contract indexed to the Consumer Price Index in European Union. IAS 39 requires separation of embedded derivative from the host contract when the following conditions are fulfilled. First, the economic risk and characteristics of the embedded derivative are not closely related to the economic risks and characteristics of the host contract. The second, a separate instrument with the same terms as the embedded derivative would meet the definition of a derivative. And third condition, the hybrid instrument is not measured at fair value with changes in fair value recognized in the income statement. Separation means that you account for embedded derivatives separately in line with IAS 39 and the host contract, rent in this case, in line with other appropriate standard. If an entity is not able to do this, then the whole contract must be accounted for as a financial asset at fair value through profit or loss. Finally, we will also briefly touch the issue of hedge accounting. Detailed explanation of hedging is not a subject of this video, but just very briefly, you should be aware of the relationship between hedged item. This is some risk you are exposed to. For example, some asset in a foreign currency that might lose its value due to unfavorable exchange rate changes. And then there is a hedging instrument, something that offsets your risk in a hedged item. For example, some forward contract to sell foreign currency at a specified date. In order to apply hedge accounting, IAS 39 requires the following conditions to be met. Hedging relationship is at its inception formally designated and documented, together with entity's risk management objective and strategy for undertaking the hedge. The hedge is expected to be highly effective in achieving offsetting changes in fair value or cash flows attributable to the hedged risks, consistently with the documentation. For cash flow hedges, a forecast transaction must be highly probable and must present exposure to variations in cash flows which can affect profit or loss. And the effectiveness of the hedge can be reliably measured. And finally, the hedge is assessed on an ongoing basis and determined actually to have been highly effective. IAS 39 then describes hedge accounting for three types of hedges. Fair value hedge is hedge of the exposure to changes in fair value, and the gains or losses from the change in fair value of the hedging instrument and adjustments to carrying amount of hedged items shall be recognized to profit or loss too. Cash flow hedge is a hedge of the exposures to variability of cash flows, and here you shall calculate effective and ineffective portion of hedge. Then effective portion of the gain or loss on the hedging instrument shall be recognized to other comprehensive income, and ineffective portion shall be recognized to profit or loss. The third type of hedges is a hedge of a net investment in a foreign operation, and it is accounted in the similar way as a cash flow hedge. So, that was a brief overview of the standard IAS 39. In our website www.ifrsbox.com, you can find lots of IFRS articles, videos, and Excels. If you subscribe to our newsletter, you will get our free ebook short guide to IFRS. Thanks for watching.